I'm now joined by Joel Shulman, founder and chief investment officer at ERShares, who currently offers two ETFs with over $200 million invested. They also offer mutual funds and separately managed accounts, about $800 million in firm assets altogether. And the blueprint for their investment process was actually laid out in a book Joel authored. It's titled Getting Bigger by Growing Smaller, a New Growth Model for Corporate America. That was born out of research developed at Harvard University. And I'm now very pleased to have Joel on the line with me from Boston. Joel, it's a pleasure. Thanks for taking the time.
Thanks for having me here. It's always fun to participate in these podcasts, so thank you.
All right, so let's start with what you call the entrepreneur factor. So my understanding is you believe this should be held in the same regard as value or momentum or size. So explain for us what this is and why you do believe it holds up against some of these other well-known factors.
Well, actually, we've tested this numerous times using analytics on Bloomberg, where they have 30-plus factors, similar to what you mentioned in terms of momentum and size and growth and so forth. And what we found is that over an extended period of time, not only is what we call the entrepreneur factor significant, it's frequently the most significant over a period of time, and sometimes more significant than all the other well-known factors combined. And so we're very proud of this factor, and it's a trait that transcends centuries in terms of growth in economies globally speaking. So this is something we've discovered, and it's something that's been true a long time.
And so explain that factor. What exactly does it represent?
Well, it really first and foremost represents the key leaders of any organization. And, it turns out leadership matters. And so, having the right mix, having the right charismatic leaders, they're fully invested. It's more than just the money. They do this because it's also, driven by ego. When you think about the innovations and disruptions happening, globally, it's a handful of people and their tight team that stay together, and they work, night and day to create solutions. And so it's really all about execution. So it's really the team and the way they manage the resources.
Okay, so the two ETFs you offer that are based on this entrepreneur factor, you have the ERShares Entrepreneurs ETF, ticker symbol ENTR, and the ERShares Next Gen Entrepreneurs ETF, ticker symbol ERSX. Take us through these ETFs, maybe starting with ENTR.
So ENTR was our first ETF. It was launched over 3.5 years ago, and it primarily invests in U.S. large cap companies, very liquid companies. But it's more than just the things. I mean, we have the next generation, the Squares, the Rokus, and so forth, the Twilios, and so we have. Again, well-known companies that has more of a tilt towards tech, but we have some healthcare in there as well, quite a bit of healthcare as well. The next-gen ETF, ERSX, is a little over 2.5 years old, and this is primarily non-U.S. or international small-cap companies. And so it provides an exposure that many people don't have. It includes many companies that are not ADRs. We invest directly into the markets, whether it's directly in Hong Kong or Thailand or Cambodia or wherever it may be, and as well as Europe and Latin America. So this provides a different exposure. And then we've got 3 mutual funds that are going to be converted to ETFs in the very near future.
Okay, so on the two ETFs, if I look at ENTR, it has approximately 30 holdings, ERSX, approximately 50 holdings. So, clearly these are more concentrated. You're really whittling down the respective investment universes here. How are you doing that? I mean, what's the filtering process?
Well, so we've got models that we've developed starting, over 20 years ago when I was working at Harvard and working, studying at Harvard and writing the book with the former president of Chrysler Daimler. And we created this model that addresses what does it mean to be an entrepreneur. And so if you go to traditional databases, there's no filter identifier for entrepreneurial companies. So we have to kind of impute what does that mean. And so we go through a series of quantitative and qualitative data. We started with 15 traits. We've since moved it up to closer to 20. And we do this, and we do it on a very active basis. And so we're going through reams of data, going through more than 55,000 publicly traded companies, and identifying certain traits that we like to see within company holdings.
What are some of those traits?
Well, with the leadership criteria, it's a focus on the key members of the team. We like people who have been there for a fairly long period of time, that have low turnover among senior management. We like to see the way they're investing their funds. So we see organizations that tend to grow or organically rather than through acquisition. When they grow through acquisition, they usually accrete SG&A savings or expansion to margins, and these are companies where they actually grow their clientele too. So not the clientele, they grow their employee base too. So these are companies that, again, because they're growing organically, for those investors who like ESG criteria, they have this too, because the governance traits are very strong. That we actually select them based on this. They have low carbon footprint, so the E is very strong. And from a social standpoint, they're creating jobs in society. And so whereas the Fortune 500 lose jobs, these companies tend to create jobs in the marketplace.
I thought maybe a good way to sort of crystallize the overall idea here, can you highlight a company or two in either ETF that you think really captures the spirit of the entrepreneur factor?
Well, when you think about Square, you've got, this is a well-known company. You've got an iconic, leader. These again, people are very familiar with Amazon and Facebook and Netflix and Google, but there's a whole host of other companies, just below that mark that we've got, great entrepreneurs who are running them, and so Square would be an example. We've got globally, companies around the world. Tesla, of course, is a well-known example, but people have studied, Elon Musk, quite a bit. But there are plenty of these companies that go on and on and on. Square, Roku, Cloudflare, NVIDIA, the Datadog, DraftKings. The list goes on and on and on.
Joel, a few minutes left. I'm curious, what's your take on the current thematic ETF landscape, especially if we zero in on quote-unquote disruptive innovation? So I'm sure you're familiar. Well, I was going to say, you look at the success of ARK Invest. I know there are several other thematic ETFs that are built around disruptive tech. What's your overall take on this space?
Well, so first and foremost, we were around before some of the others that you've mentioned. So we actually started this 15 to 20 years ago, and some of the others came out in the last 5-6 years. So the entrepreneurs, have, in many cases, they are the disruptors. They are the innovators. Many of these names that you find in other funds are in ours too. We don't have them concentrated in tech funds or in healthcare funds and so forth, but we have many of the names, mixed throughout all of our portfolios. Now, they had kind of a rough last 2 weeks, but this being March 9th, as of the taping of the show, there's a very strong recovery. And so, these tech stocks, these disruptors, had an extraordinary 2020. They had an extraordinary beginning to 2021. They had 2 weeks where some of the profits were given back, but they're recovering very nicely as of today when we're speaking. And so, and we believe through the remainder of 2021, they're going to be very strong companies. These are companies that aren't going away. And in fact, what happens is periodically the pendulum swings, as most of your clients, most of your listeners know, it swings from one bucket to another. So it went from value to growth over the last few years, and then from growth to value just recently, and now it's shifting back. We're seeing, in the case of value stocks, as of the time of this recording, some of these stocks are all-time highs, and they're flirting with these are not entrepreneurial stocks; these are value stocks that were flirting with bankruptcy through much of 2020, and they're at all-time highs. And so that doesn't make sense either. So we're going to see a shift back to growth. You've got companies that have extraordinary. We have cases of fintech companies that have increased 700 or 800% in revenue growth over the last 2-3 years, and 100x on profit growth over the last 2-3 years. And and these are companies globally that we're tracking. So I think long term, you're going to find investors like to gravitate towards strong growth, disruptive stories. They may flirt with the idea of going away for a week or two, sometimes 3, but they'll come back. And we think long term, value creation is with these types of companies, and we think listeners to your show will appreciate the long-term growth they have in their portfolios from these companies.
So just to summarize there, I think that's really interesting perspective. It sounds like you think this might be a bit of a head fake in value stocks, because I look at the market right now, there does seem to be a growing camp of investors who believe we might be seeing a more pronounced rotation out of growth stocks, right, into more value-oriented stocks. There are concerns over valuations, rising rates, but it sounds like you think growth may bounce back here more permanently.
Yeah, I mean, if I'm allowed to mention names, I can cite a few stories today.
Yeah, please.
Oh, well, so if you look at Avis, I mean, Avis is a company that, for many of us growing up, was running. In fact, their tagline was, "We're number two, we try harder." Well, number one, Hertz, went bankrupt last year, and Avis has a capital structure very similar. They're at an all-time high. I mean, we look at Marriott International. I mean, they're at an all-time high, and, their revenues were off 50-60% last year. They've got rising debt levels, and they've got rising debt levels with interest rates going up. And in competition with Airbnb and other companies that are nipping at their heels. It's not unlike what's going on with Uber and Lyft and what they've done to the cab drivers. So, the hotel industry is being disrupted, and yet this company is an all-time high. And then you've got restaurant chains like Bloomin', the parent to Outback Steakhouse, among others. I mean, they've got rising debt levels, and their revenues were way off, and they've got obligations coming due. And they were flirting with bankruptcy, and they're at an all-time high. And then you've got SeaWorld. SeaWorld's perhaps the best example. They were down 81% last year in revenues, and they haven't invested anything in property, plant, equipment. They're hemorrhaging cash, and yet their stock is all-time high. It makes no sense. So you've got a lot of value stocks that are at or near all-time highs, or in the case of Avis, it's at a 15-year high. It makes no sense. I mean, they're in disrupted industries, and while it's important for listeners to know that I believe that they should no way be near the bottom, the depths of the pandemic, but they certainly should not be at all-time highs given the state of their future affairs. Whereas you have these growth stocks that until recently were off 20-30% in the last few weeks as of taping the show. Some are off 50-60%. And they're, as of today, the taping of the show, many of them are off 15-20% today. They're having a very strong recovery. And so we think long term, the place to be is in growth. And if you're in some of these value names I just mentioned, I strongly encourage you to get out, because whereas growth stocks might periodically drop 20-30% or 50%, there's a floor. Whereas if you're in a value stock and it goes up to all-time highs and it goes bankrupt like Hertz or some of the retailers last year that we're familiar with, Sears and so forth, you can go to zero. And so value stocks that blow up go to zero. Growth stocks, which give back some of their gains, might drop 20-30%. So we think long term, the place to be is in these innovative, disruptive, entrepreneurial stocks that have bright skies ahead.
Well, Joel, I think that's the perfect ending point. Really appreciate your perspective on the market. Certainly an interesting approach with ERShares ETFs. Wish you continued success, and thank you for joining me.
Thank you so much for being on your show. I'm happy to join anytime you like.
That was Joel Shulman, founder and chief investment officer of ERShares.